So first things first, guys, as you probably already noticed, my background and even my appearance is a little bit different than usual. So in case you didn't see our last video or our social media posts, we are currently in Coronado Beach in Panama. So we have finally realized our dream of snowbirding for the winter this year, and we owe it all to financial independence and passive income. I'm not telling you guys to show off. I'm telling you to hopefully motivate you to save, invest, and become financially independent as soon as possible. Regardless of where we are, however, we will continue making good content for you guys. And our goal is really to keep publishing at least one video a week every single Sunday. So don't worry, the content will still be coming your way. The more time goes on, guys, the more confident I get about investing on my own as a do-it-yourself, as a DIY investor. So the same applies for everything else in life, right? If you think about it, the more experience you have, the more at ease you are with whatever you're doing. So let's face it, however, when you first start investing on your own with that hard-earned money you worked for, it can be quite scary and overwhelming. Trust me, I know, because I've been there, and I know many of you watching have stock market jitters, especially if you recently started managing and investing your own money. I mean, who wants to lose their hard-earned cash, right? Nobody. And it doesn't help with the consistent bombardment of news, of articles out there about the economy, about the stock market, volatility, and what it's doing on a day-to-day basis. I mean, every day there's something new and something to be scared about, right? So the question is, how do you get over the fear? How do you sleep well at night knowing that your money is vulnerable to whatever the stock market is doing? So in this video, guys, I'll share with you 5 key points to help you sleep better at night if you're a newer income-oriented investor like me. These 5 points definitely is what I think about to calm me down whenever I'm worried about investing. So if you just repeat them in your head, you'll see that with time you will become not worried at all and just sleep like a baby. So listen up, remember these points, guys, and sleep like a baby while your money works for you. Point number 1, let's get into it right away, is remembering what you're really investing in. So the stock market can be a pretty crazy place with all kinds of stuff, guys, but remember what you're actually investing in. If you're a conservative, income-focused investor like I am, chances are you will be primarily invested in ETFs, closed-end funds, and split-share funds that invest in solid, safe, blue-chip companies. They're called blue chips because the blue chips in poker are the most valuable. So the definition of a blue chip stock or company in Investopedia is the following. A blue chip stock is a huge company with an excellent reputation. These are typically large, well-established, and financially sound companies that have operated for many years and that have dependable earnings, often paying dividends to investors. Here's the definition of a blue chip stock from Wikipedia. A blue chip stock is a corporation with a national reputation for quality, reliability, and the ability to operate profitably in good and bad times. So good and bad times, right? I really like the sound of that. So I feel like many newer investors lose sight of what they're actually investing in. They think they're investing in the ETF or focus too much on the ETF or fund itself. What you should really be looking at, guys, is what's inside that particular ETF or fund. That's what you're really investing in. The ETF or fund is just a middleman. Think of it that way. Blue chip companies are completely different, guys, from risky small companies or startups that are not even profitable yet, penny stocks, right? They have been around for a really long time. Some over 100 years. They pay consistent dividends, which are essentially profits. Don't forget that. So they're profitable, well established, with usually most of them have international operations as well. They have some of the best talent and executives in the world. They can access a crap ton of money very cheaply and have sometimes a lot of power in government as well. Again, don't forget what you're investing in, guys. Point number 2, diversification is a protection against ignorance. Famous quote from Warren Buffett. So a very famous quote from one of the world's most famous investors. What does he mean by that exactly? Well, I'll put the clip of him talking about this below, but I quote him here. Diversification makes very little sense for somebody who knows what they're doing. If you want to make sure that nothing bad happens to you relative to the market, you own everything. There's nothing wrong with that. That's a perfectly sound approach for somebody who does not know how to analyze businesses. End quote. What a powerful and true statement from the master himself. Don't forget that guys like him and other famous fund managers are always trying to pick and choose stocks and businesses to try to beat the overall market, and most of them fail anyways. So doing this stock picking is extremely hard for the everyday person like you and me. Many regular people try to do this with gut feeling or reading articles online or hearing rumors from friends, etc., etc. Trust me, your chances of success long term are slim to none, just like at the casino. You are literally competing with titans, guys, like Warren Buffett, who have all kinds of analysts and tools and resources at their disposal, not to mention knowledge, a lot more knowledge than us, and a ton of money, right? So trust me, trying to be an active investor and choose stocks is really the dumbest thing you could try to do, in my opinion, especially now with artificial intelligence as well. If you diversify and invest in all stock market sectors, nothing bad will happen to you, like Warren Buffett says, because some sectors do bad, some sectors do well at different times. Some are cyclical sectors, so they have their cycles like energy and financials, and some are more stable defensive sectors like utilities and healthcare. So being diversified should definitely take the edge off any investor. Is it a foolproof, perfect plan? Of course not, nothing is, but trust me, it certainly helps in bringing a level of safety and stability to any portfolio. Point number 3, guys, covered calls add stability and some downside protection. The bread and butter of my income focused strategy is really covered calls, guys. I have a nice long video explaining exactly what this strategy is, but in short, whether you are writing covered calls yourself or investing in funds that do covered calls like myself, you are essentially giving up some potential stock price upside or capital appreciation for more income. Covered calls is a very well-known zero-risk strategy to really enhance your yield and provide you some downside protection during volatile markets. Why does this add, or why do covered calls add defense and safety? Well, because this strategy typically does great during stock market volatility and stock market crashes, because all those calls that you write or that the fund manager writes will not be exercised during falling stock prices, right? And on top of that, the premiums that you get from those covered calls is higher during volatility. The premiums are worth more when markets are more volatile. So this is why whenever you look at a covered call ETF, for example, on their website, they usually say something along the lines of provide some downside protection. Remember, guys, that the main source of return you get as an income focused investor like me is not from capital appreciation. It's from the consistent passive income that these funds generate. And nothing provides that better than a covered call strategy, because it's a defensive strategy at heart, where you don't need to worry about the day-to-day fluctuations of stock prices. This is why I always say that I don't care about stock prices, up, down, flat. I really don't care. I'm making my money with time, not capital appreciation or stock prices rising. It's a different way to invest. These funds have two sources of income instead of one: dividends and call option premiums. Those are the two combined. So when do these funds shine the most? Believe it or not, well, it's during volatility, during market crashes, and during flat stock market time. So this should help you sleep better, especially when volatility or a crash comes, because you need to remember that these funds, anything that uses covered calls, tend to outperform the overall general market during these times, and even during a flat and modest bull market. They only underperform during a strong bull market. So let's check out how BMO, the biggest covered call ETF manager in Canada, describes their covered call ETFs. I found that interesting, and I want to show you a nice little graph from Horizons that shows how these covered call funds do in various market conditions. So I just want to quickly show you guys the list of BMO ETFs here. I'm basically here. I'm in the product list. So this is just list all the BMO ETFs. And if you scroll down to look for where the covered call ones are all there, are classified, they're classified under specialty income. So this is where all the BMO covered call ETFs are, from ZWC, ZWU, etc., etc., etc. And I just want to point out here, I found this very interesting. You see the ETF objective, it says defensive income equity. So there's a reason why they say defensive, guys. They all say defensive here. And if you just click on any one of them, you will see that one of the main points here, if you go at the bottom, one of the main benefits is right here: call option writing reduces volatility. So this is where the defense comes in. This is where the covered calls shine. It reduces your overall the volatility in your portfolio because of those covered calls. I also want to bring your attention to this graph here, which, you know, I'm just taking one of the product sheets from one of the Horizons covered calls ETF, but I think they all have them. This is just the gold producers one, HEP. It's actually the gold producer fund in HDIV. But what I want to show you is this graphic right here. I think it's really interesting. So this is what they're trying to show is how a covered call strategy can typically be expected to perform in the following market. So you have a full-blown bear market here, so market crash, volatility, whatever you want to call it, the bad times, right? And you actually see that the covered call strategy outperforms. When you see outperform or underperform, they're talking about the performance relative to the overall or general stock market. So in a bear market, it outperforms. In a range-bound market, which I usually call a flat market, or just like where a market doesn't really do much, it just zigzags up and down, but it stays relatively flat, it also outperforms. And even during a modest bull market where stocks are going up very slowly long term, it also outperforms. It only underperforms when there's a powerful bull market, right? Because the chances are that your stocks are going to be called away when you're writing a call option. So I just wanted to show you this, just really to show you how covered call strategy really outperforms during especially the bad market. So when volatility and bad markets come, think about these graphs, guys, and that should give you a level of stability in your brain and make sure you're sleeping well at night. All right, guys, point number 4, income investors typically never sell. So this is one of my favorite ones, and many people who transition from a growth strategy or active investing typically have a hard time remembering this because they have been so fixated their whole lives on just one thing: stock prices and stock charts. So this is normal if you're a growth investor, right? The only way to make money is to grow your capital. They buy an index fund or a growth stock or an individual stock at one price, and they need to sell it at a higher price later on to make a profit. So income investing, guys, is completely different. It's the opposite even. You don't make money by selling at a higher price because income-oriented funds typically don't grow much over time. Some don't even grow at all, but that's okay, guys. They are designed that way. They are designed to pump out as much income for you as they can. So it's normal. Many people have a hard time with this because they absolutely want growth. Personally, I don't care about growth whatsoever. I only care about income, the passive income. So I'm currently making over 10% yield on my portfolio. This means that if I don't sell anything whatsoever, I'll make a 10% plus return that year, right? And it's not a fantasy return like growth investors get. It's a realized return. Income investors make their returns with cash flow over time. Growth investors make money with capital appreciation, and to realize that growth, you need to sell. If you don't, your growth or capital appreciation is a fantasy. It's just on paper, and it might disappear the following day if there's a stock market crash. So that's what I'm trying to tell you. So what stock prices do really makes no difference to an income investor, but makes all the difference for a growth investor. This is why I sleep like a baby, guys, and never watch the news or read articles or care about the latest gossip and predictions. Trust me, guys, it's so much better. It's sad. It's sad, but way too many people lose track of time and their lives by being worried and constantly watch the news, which is all designed to pump fear in your heart anyway. If this is you, well, I strongly suggest you consider becoming a passive income focused investor like me. Point number 5, guys. Last one, be stoic, focus on things you can control, and try to think of the worst case scenario. So before I even read up on what Stoicism is, I already thought a lot like a Stoic. So in case you have no idea, Stoic philosophy was founded by a guy called Zeno in the 3rd century BC, and many famous Romans, my ancestors, like Seneca, Cato, and probably the most famous of all, the Roman Emperor Marcus Aurelius, the guy in Gladiator, they all practice this philosophy and way of life. So I won't give you a lesson on Stoicism here. You can look it up yourself on YouTube, and I'll see if I could put some links to good videos below that I found useful. What I could tell you for sure that it's a really good mindset to have as an investor. The gist of the philosophy is that it's completely pointless. It's completely a waste of time worrying about things that are out of your control. It's a complete waste of time and mental energy. Most things in our lives are out of our control, including what goes on in the world, the economy, and stock market prices, which is basically a representation of people's perception of the economy. So instead, it's best to focus on what is in your control, like your emotions and reactions to certain things. This way of thinking really helps you and has helped me stay cool and calm no matter what, and to always be logical and pragmatic about things. So trust me, it helps as an investor tremendously, especially during a stock market crash or volatility. Reason with me here, guys. Stock market crashes will happen. It's inevitable. So when they do, what should you do? Panic and sell stuff at a loss? I know many of you watching have done this and you have all regretted it, right? So trust me, I have been through a crash and in 2020, and the best thing to do is nothing. That's right, nothing. To wait it out, let the storm pass, because it always does. Oh, and it's very easy to be passive and do nothing, by the way, if your investments are still paying you income every month, regardless of what the market is doing. That's the power of that covered call strategy. Another thing Stoics always do is think about the worst case scenario so you're ready for it in case it happens. This way it's not a surprise. So for investors, it would probably be a full-blown market crash, recession, or depression, right? So since I've had the pleasure of going through a sharp market crash already as an income investor in 2020, I could tell you from experience that it really isn't so bad. Yes, you see your capital go down, but the beauty of the passive income strategy is that most of your income stays intact. This is once again thanks to those covered calls, as these funds have no issues to keep paying the distributions, because the distributions are not just based on dividends, which could be cut, reduced, or temporarily suspended, but it's dividends plus the covered call income. So you have that safety net there. Not only that, but the premiums or the call premiums are higher during volatility. So those funds might even generate more income. A great example would be the CI covered call ETFs, right? If you look at their distributions for 2020, I'm talking about funds like NXF, CGXF, TXF, the tech one especially, even FLI, the life insurance one, even the bank ones, CIC. They provided higher income in 2020 during the crash. That's pretty crazy, right? So this further proves that covered call ETFs, just like we saw in the graph, outperform, or they shine during volatility. Worst case scenario, guys, let's think about it. You might temporarily stop getting distributions from some of your split funds, maybe. That's the only bad experience I had, but that's about it. So this is why I always caution everyone not to make split funds the majority of your portfolio, and have a mix of split funds, not just the ones that are higher risk with lower unit NAVs close to $15. Because those are more at risk when markets take a turn to stop paying out, right? So the worst case scenario for an income investor, guys, is really not so bad. And the best thing to do during a crash is nothing. Pretty easy, right? So that's it, guys. I hope you enjoyed the video and it's helping you, or it helped you to avoid or not have stock market jitters anymore. So as usual, please hit that like button. I would really appreciate it. It helps the channel grow. It's a win-win. Also, if you like this type of content on investing, make sure you're subscribed, especially if you're an income-focused investor who's looking for passive income. That's the stuff that I really concentrate on. Of course, don't forget to visit our website, passiveincomeinvesting.ca. That's where you could purchase my digital product, the Ultimate DIY Investing Package, which is on version 3. It comes with lifetime updates. It's really a companion and reference tool to help you invest. It has sample portfolios. It's good for Canadians and Americans, or those of you who invest on the US market. So make sure to check it out on my website. All the details are there. I also offer a one-on-one consultation service if ever you want to book a call with me via Zoom. It's right there on my website as well, right on the homepage. I'm completely sold out for December and January, however, so the next appointments will be in February. Make sure you join us on Facebook and follow us on Instagram. That's where we make the announcements, by the way, when the appointments are open. So make sure you follow us on social media if you use those platforms. As usual, guys, what do I leave you? Stay safe, stay passive, and see you next time.